chapter 14. Chapter 14 kind of brings a lot of the concepts together that we've been working on. So let's dive into it, and it'll help you in preparation for your turning in your project next week. Okay? The whole concept of what we're doing with the project and how you make a decision on which company to invest in is understanding what each business does and its unique approach to the marketplace. You know, what are its competitive advantages, disadvantages? How does it take on the competition? Because they each have their own approach. They each have their own market niche, so to speak. Okay? There are things that go on inside the company that drive whether or not they're successful, right? It can be management, it can be how they treat inventory, whether or not they have inventory, things like that. Remember, like eBay and Amazon? Amazon, nobody has those two companies. Amazon has a ton of inventory. They have these great big buildings full of inventory. Lots of cost associated with that. eBay sells stuff online all day long. They own absolutely nothing. They're selling other people's stuff. And they just make a cut off the top. They compete head to head, but one has a great big cost that the other one doesn't. So it's different approaches to the market. As we've seen with the economy, there can be things that go on that will affect companies, right? We just went through this great big economic downturn, and that's an outside factor that can determine whether or not you're successful. Your industry factors is how your competitors approach the market and whether or not they're taking your market share, your customers. Okay. We talked about this a little bit in chapter 11. Investors are always looking for a return on their investment, a profit on the money they've invested. Some investors just want the dividends. Remember, this was the example where we have somebody buying a utility stock, and they know that they're going to get that 50-cent per share dividend every quarter, every year, year in, year out. It doesn't ever vary. The stock price doesn't go up much, but they're going to get the dividend. On the other side, some companies don't declare a dividend because they reinvest all the profits back into the company to help it grow. And what investors are looking for there is the appreciation in the stock price. So those are the two extremes. Typically what's going on is somewhere in between, where you're getting some dividend and some increase in price, and that's how you get your return on the investment.
Does profitability between the two different ones kind of depend on the business? Like whether...
Profitability between the two different...
I mean, whether you would want returns on dividends or increase in share price, like to get the most profit.
If this company is, dividend driven and they're making a profit, their dividend will go up. So people will pay more to get that larger dividend, right? And over here, even though the company's not declaring a dividend, if they are making more money, their share price will go up because people will bid more to own a piece of that company. So profits are going to drive both ends of the spectrum. Okay? All right. So as you're doing your report, remember you want to look through the notes, understand the business strategy, the letter from management, understand how they're competing in their environment, in their industry with the competitors, right? That's why you're comparing two companies, and understand how to go through and analyze the financials, which we're going to get to in a lot of detail here with a lot of ratios in chapter 14. We're going to kind of review all of them, okay? But I want to throw in one more little tool for you that we haven't covered yet, and that's called horizontal and vertical analysis of the financial statements. And what you're doing there is, if you have two different size companies, right? If you've got, somebody has Oracle and Red Hat, right? Oracle has sales in the billions of dollars and Red Hat's in the millions.
Red Hat just sent an email.
and just entered the millions. They're, David and Goliath. How do you compare those companies? Well, the analytical ratios that we've been using convert those vastly larger and smaller numbers into a ratio you can put side by side, head to head. You can take your income statement and convert the whole income statement to ratios and compare them line by line. And you can do the same with the balance sheet. And that's what I mean by horizontal and vertical analysis. And again, remember, you can compare this year to last year to the year before to see if they're improving or getting worse over time. Or you can compare your company to the other company to see if they're doing better or worse over time. And you do that within your own company because, maybe sales this year are more than last year and more than the year before that. So as sales grow, you want to be able to compare. Yeah, I can feel that cold air all of a sudden too. Up high. Up high, there's a hook. Yes. I can't edit that out. Stop. You're fired.
Yes.
How much time do you spend on editing?
As little as possible. Just where he's screwing with it. And if he puts it in the middle, I'll forget. And then it'll be there forever. Yes, ma'am.
Quick question. On the final project, like you said, the horizontal and vertical, can we just use the ratios and analyze it? Because like with Oracle and Red Hat, it's
You might want to throw this in there. You might want to look at this real quick. And if you dump all the data into a spreadsheet, it's very fast. Okay? Yes?
Is it kind of like the analysis that we did in accounting?
Accounting 6. That's horizontal and vertical. Okay. So let me show everybody else how it's done. And here's the key. If you're dealing with the income statement, you take every line on the income statement and calculate it as a percentage of net sales. So net sales is 100%. Your cost of goods sold might be 80% of sales. Your salaries and wages might be 5% of sales. So think about this. Where did my pen go? All right, in year one, let's say I have $100,000 in sales. And my wages expense is, what's 5% of this? 5,000, right? So there's 5%. In year two, I have $200,000 in sales, and my wages expense is $30,000. What's that as a percentage? Somebody quick. My brain's gone.
60.
What?
60. I think 15%. Will that make sense?
No.
60.
10 and 20.
What?
20 and 20.
What?
For the 200, that's 15%.
This is 15? Okay. So I've done better. I've made way more sales, but my wages expense is way out of whack. Am I better off or worse? I'm worse off. So that's the kind of analysis that we're talking about in a ratio analysis. Okay? So I'm comparing this year to last year. This is a horizontal analysis year to year. Okay? Yes, sir.
Out of whack because your sales is 1 to 2 and the wages are 1 to 3.
Right. So if I had still had 5% over here, I would be doing okay. But I'm not. I'm spending way more to chase this additional sales. Okay? And then on an income statement or on a balance sheet, you convert everything to a percentage of total assets. Okay? I do this one a lot. This one only sometimes. So just as a quick example, here we go. Net sales divided by itself is 1, so that's 100%. Cost of goods sold divided by net sales is 66%. Gross profit divided by sales, 33.6%, and so on. And you just work your way down the entire column. and you convert everything to a percentage. Okay? Easy to compare. Am I doing better this year against last year? Notice this number is pretty darn consistent. That's a good thing, right? Look for the ones where I'm doing operating expenses, 20.4% to 22 to 25. Am I doing better or worse? It's going the wrong way, right? So it's costing me more, and therefore, as a result, I would expect my net earnings, my profit, to go down every year, which it does. Now, the book likes to show the actual income statement, and then they come over next to it, and they'll put the 3 columns of percentages. When I do this, I go numbers, percent, numbers, percent, numbers, percent. Just do what works for you. Some people consider them side by side easier to read. I got used to doing it the other way. Questions on that? It's a cool trick. That's not a trick. Stop. Okay, balance sheet. Assets, total assets. Remember, when you do a balance sheet, you're taking everything as a percentage of total assets. Well, there's the rest of the balance sheet. So even though you're down here taking total current liabilities, you do it as a percentage of total assets, right? It's got to be, you have to use the same benchmark, otherwise you don't have that relative comparison. Okay? If you wanted to, and you got into a habit of doing it as a percentage of total equity, I guess you could, but the norm is total assets. Okay? Yes?
So let's say for one of our companies, Red Hat, they sold one of their buildings last year.
Mm-hmm.
So if their building cost went down, or the money that they lost on the building, would that reflect in the ratio?
Well, the money lost on the building would be an other income and expense net of tax down here below. It's non-operating. So it would show up, but the non-operating expenses are unique and not non-recurring, so they're not as important as your normal operations. Okay? If you focus on everything down to operating income, you're probably focusing on the important factors.
You wouldn't do that on what we have.
You could. And, I would just carry the column down because you're doing it in Excel and it takes you 0.3 of a second. So, okay? So you do the same thing with the balance sheet, but off of total assets. Okay? The rest of, go ahead.
So are you making a suggestion for us to do the vertical and horizontal analysis, or
You may want to do that.
may or must or?
You may want to do that. It would be good for you to do it and look at it. I wouldn't spend 6 hours doing it. I might spend an hour and just see if anything pops out. Okay? Because it will tell you a lot about your own company if it's doing better or worse relative to prior years. Okay? It will also tell you a lot about comparing the two companies and their relative competitive advantage. And by that I mean, like the example over there. If company A can turn out $1 million in sales for 5% cost, for 5% labor cost, and company B can't do it, they have to spend 20% labor cost, there's a distinct advantage there. What's going on? So it can help you identify things like that.
So wouldn't the ratios that we calculated in the last journal help us determine that information as well? Not as
These aren't those same ratios. Those other ratios are what we're now about to dive into here.
This is just a tool.
This is a new tool. It's not real complicated, and it can help you identify anomalies and differences fairly quickly. All right? Now, the rest of chapter 14 is a great review of all of the ratios we've learned so far and throws in one or two more. look through them. I'm going to stop there for tonight. Okay, I'm going to edit this out at the moment, because we'll continue next time, and I will review them with you in preparation for the test, okay? But I want to have time to go over the last test. So you can turn this off now.